I want to walk you through the difference between what someone like myself does and what someone that is a CPA does in terms of tax mitigation, tax planning, right? I say tax mitigation a lot. A lot of people just refer to this as tax planning. Whatever you want to call it, the goal is to keep more money in your pocket. And a lot of times when I meet with folks, they have a hard time wrapping their heads around the idea that, hey, you're not a CPA because I'm not a CPA. I'm a tax strategist. How are you bringing me these strategies, and why is my CPA not bringing me these strategies? And I'm not saying that all CPAs do not focus on, the same strategies that I do, because there's some that do, but the majority of CPAs don't, because they are focusing on more of a historical approach to your taxes. They're going to look at what happened and then tell you what you owe. All right, so if we look at IRC, Internal Revenue Code, which is Title 26 of United States Code, kind of, I don't know why I'm writing that like that. Anyway, this is the tax code. I'm just going to refer to it as the code, okay? And so the code has 70,000 pages when you include revenue rulings and regulations and all of these different court cases, but the actual code itself is only about 2,600 pages. So what the actual tax law is only about 2,600 pages. I say only as if 2,600 pages isn't a lot. That is a lot of pages of reading material. Now, 30 to 40 of those pages actually say what you owe. Okay. The rest is specifically, so what is that, 69,900 and let's call it 60 pages. This is going to tell you how to avoid taxes, how you can reduce your tax liability. I shouldn't say avoid taxes, but avoid unnecessary taxes, okay? So that's the reality of it. Now, when you think about it, when you think about how CPAs and in the accounting industry as a whole, I think there's about 672,000 CPAs in 2025. That was the last time I looked it up. That was the number that I saw. There are more leaving the industry that are joining the industry. People that are in their 20s, really 20s and 30s, they want to be an Instagram influencer. They want to be a YouTube influencer. They don't necessarily want to go out and do taxes for a living, okay? So more people are leaving that are entering, which means your CPA more than likely has a bottleneck. They probably have, I'll use my family's example, my personal example. I use the same CPA that my aunt uses, that my mom uses, that my dad uses, that my entire family uses, right? And so one day I called her because I had a question on my taxes and I couldn't get a hold of her. I finally got through to her assistant. And I said, well, can I not talk to, my CPA? I'm not going to say her name in this video. And the girl said, no, we have 6,000 clients with, I think, 6 on staff. You can't have a meeting with her just to ask this question. If it's an urgent matter, you can schedule something, but if it's not urgent, then you're not going to be able to meet with her right now because we're so busy. So think about that workload. 6,000 clients, 6 CPAs, that's a lot of work to do. And there's, only so much time. We only have so many hours in the day. So when you really think about it, CPAs have a bottleneck. And the reason that I bring that up is because they're focusing on filing taxes, not necessarily forward-thinking planning. And so they don't really have the time to go and dig through 69,000 pages of code. Okay, they're busy working on, actually filing their returns for their clients. So unlike me, I don't file returns. That is not my job, and nor do I want to file returns. So that is a terrible spectrum. I'm going to redo that. Like you've probably heard me talk about in other videos, but I don't file taxes. I don't want to file your taxes. That's not my job. My job is to bring people like yourself, high-income individuals, tax strategy, okay? I make a living by saving wealthy people like you money in taxes. That is quite literally how I make my living right now. And so my job is to go through 69,000 pages, which I don't necessarily do it like that. I find very smart tax attorneys and financial advisors that bring these strategies to me so that I can bring them to the market for people like you. But our job solely is to focus on the actual strategy, make sure that it's compliant, and then we plug it in with your existing CPA. And we don't necessarily have to get the approval from your CPA. It's ultimately your approval and your decision. But it's always helpful when we can explain, hey, this is what the code says about this. This is how we can substantiate this. This is how it's legal. This is what we're doing here with this strategy in order to save Mike money on his taxes. He's making 700 grand W-2. We're going to use X, Y, and Z strategy. It's going to save him 50 grand. Here's how you file, his taxes based off this strategy. So that's kind of how we fit in. It's like your team of advisors or consultants or whatever you want to call it. You got your financial advisor, you got your CPA, you got your tax attorney, or just your attorney in general, and then you have a tax planner like myself. That's kind of how we all fit into the picture to help you out. So this is the taxpayer spectrum, okay? And this is my iPad that I'm writing on, so my handwriting is always really sloppy on this. So in the middle of the spectrum, you just have the full payer. Right? This is, for example, your W-2, standard employee that they're not doing any strategy really besides, a 401k. They're just paying full taxes. If you're watching this video right now and you're making 500 grand a year, you are paying 35, 40% in taxes, depending on where you live, maybe 25%, 30%, whatever you're paying. If it's over, 30%, 25% or more. You're a full payer. You're not really doing that much in order to mitigate your taxes. Maybe you have a handful of write-offs. They're not really moving the needle that much. Okay, that's just the reality of the situation. You could do a lot better if that's the position you're in. On the right-hand side, you have what I want to avoid at all costs, and that's evaders, right? This is tax evasion. I do not do tax evasion. I'm not going to risk my reputation or my career for tax evaders, for tax evasion. And so this is legitimately criminal activity, all right? You do not want to be on this end of the spectrum. This is not where you want to be. This is things like not reporting income, okay? This is things like just blatantly not paying your taxes. This is illegal, and I do not do that. So I'm going to put an X through that so you understand that if you want to move to the evasion side, do whatever you want to do, you do. It's not my decision. It's not my life. But I just understand that I cannot help with that. I will not help with that. And then on the other hand, you have, and this is kind of where I live, you have avoiders, right? And this is, I should write, and I know I'm going to mess this up because I always mess up the spelling of unnecessary. I think it's with one C. I could be wrong. Unnecessary avoiders. So this is avoiding unnecessary taxes. This is how CPAs are going to do this is through things like, let's say, Section 179. So what your CPA is going to show you how to do is say, hey, Mike, you can take your truck that you just purchased, that F-250 that you're going to be using to haul out, tree stumps on your excavation business or your tree trimming business. You use that truck for your business. You can write off 100% of the purchase price if you use it for 100% business. So let's say you have the $500,000 of income. You bought the F-250 for $100,000. You put 20% down. You financed 80%. You get to write off $100,000. That's one example of an accounting-based tax mitigation strategy. So is things like using accelerated depreciation. So I'm going to put accelerated depreciation right there. This is real estate. You hear about this all the time. Things like this, they're going to recommend things like 401k, IRA, the basic ERISA plans. So these are all examples of accounting-based tax mitigation. It's more so, hey, how do we maximize deductions? Which I'm not saying is a bad strategy. I want to be very clear on that. That's not a bad strategy. I'm in favor of this strategy. I like writing things off that I have to spend money on for my business. For example, when I drive to Mammoth Mountain to do marketing meetings with different clients there, or when I meet with clients there. Well, it costs me about $350 in fuel to go from San Diego to Mammoth Mountain, and so I'm going to write that off of my taxes. That's a cost of doing business, right? And so things like that. Now, and again, this is not tax advice. This is educational use only. I'm just trying to illustrate what we actually do here at my firm, okay? Because we do advanced tax planning and cost mitigation strategies. So then someone that falls into the tax strategist side of the house, we're going to look at, hey, what did you and your CPA do, or what are you doing right now? What is your taxable income? What's your tax bill? And then how can we reduce that number to keep more of those tax dollars that are expenses in your pocket? So let's say that, you make $500,000, and that's after you do all the write-offs with your CPA, and, we're still going to be looking at, I don't know, maybe $125,000 in taxes. Well, we might look at something like a tax equity investment where you're buying manufacturing rights to a medication that is used to help first responders. And this is an actual product and strategy that I have another video on, but it helps first responders decrease their risk of developing cancer because they inhale a lot of smoke, right? That's what the C60 medication does. And you, as an accredited investor, as a high income individual, can purchase these manufacturing rights and then donate them at the fair market value. And then you can reduce this $500,000 of taxable income by 60%, right? And then you pocket the difference. So you take these tax dollars to purchase the deduction that gets you that 60% decrease in taxable income, and then you pocket the difference. So there's going to be some type of spread in between that 125 in taxes and whatever the strategy costs. So I think in the previous video I did, it was like $60,000 was the cost of the strategy. That's one example. Or what we could do is set up an entity structure where, let's say that you have an LLC right here, and you're going to have 2% of the ownership, but you're going to have, and then there's a donor advised fund that has 98% of the ownership, but you're going to have 100% control. And what this specific strategy does right here is it only charges taxes on 2% of the total value. Okay, so that's just one example of avoiding unnecessary taxes because we can use specific entity structures in things like this. Another strategy is, let's call it, this is actually what it's called, is something called reinsurance, right? So, and I'm gonna use $1 million example here for gross revenue, but reinsurance is not necessarily a tax strategy. It is how we're going to be able to fill the gaps in your commercial liability insurance. So like tax audit insurance, for example, tax audit insurance. A lot of the times I ask clients like, hey, is there a risk that you get audited by the IRS? And the answer is yes. The risk is so low that most people don't buy insurance for that. But most people would agree, like, yeah, that's a legitimate risk. It's the reality of it happening is, or the odds of it happening are pretty low, but it could happen. Well, what if we come in and you don't have insurance for it? What if we come in and we fill the gaps in your coverage by purchasing the tax audit insurance? So using this reinsurance, which for the sake of time, I'm just going to abbreviate it, we can move out 15% of your gross revenue from your business tax deductible. So that's going to be $150,000. It's deductible to your business. You move that into your own reinsurance company. Now you're probably wondering, Jeff, why would I, buy $150,000 worth of tax audit insurance? Well, if and when you do not file a claim, that $150,000 you moved out is now going to be pocketed as profit. This is how insurance companies are so wealthy. And instead of paying ordinary income tax on it, I'm just going to call it ordinary tax, so I don't want to write it out. Instead, you're going to pay a capital gains tax, right? So this is just another example. Now, what if we used this strategy and when we shut down that reinsurance company because you didn't file a claim and you pocket that money as profit, instead of paying a capital gains tax, I set up an entity where I have 2% ownership, but 100% control. And so now instead of paying capital gains tax, I can move that money out and pay tax on 2%, and then I can have 100% control. And obviously there's a lot more that goes into that. But I just wanted to kind of paint some different ideas. And I know I'm kind of rambling at this point, so I'm going to cut the video now. But just understand there's a big difference between tax mitigation from an accounting perspective and tax mitigation from a financial planning perspective. Both are valuable, both are essential, and the ultimate goal is to help people like you keep more money in their pocket. So if you found some value in this video, I'd appreciate a like and a subscribe. You do that below, and then there's a couple resources that you can find below this video, and those resources are going to be, number one, 5 strategies on how to reduce your taxes by 50 to 98%. Actually, I think I said 25 to 98 because one of the strategies is only a 25% refund. But typically we can cut your taxes in half. So to find the other resource, again, it's below. It's going to be for W-2 specific employees, which I went over that a little bit in this video here today. But grab those resources, dig through them, and then leave a comment if you have any questions. Hope you have a great day. Take care. Bye.